Today, I'm going to be discussing when you should use options for trading and when you should use futures for trading. Now, this is not financial advice, but these are just some of my takeaways, many of which might actually surprise you guys after over half a decade of trading experience that I have gathered. So, without further ado, let's get right into options versus futures, okay? So, the first thing to know is that price is fractal. Now, what does that mean? This means that the same technical setups appear across different time frames on your chart. So, that's to say that if you're trading based on technical analysis, which a lot of you probably are, especially you guys watching my channel who might use my same trading model, what you're going to see is that your trading model is often going to present itself across various time frames. Now, I've made videos on my specific trading model, and I won't teach that model right now because that's not what this video is about. But if you know, you know about my stim model, right? I want to sweep, a tap, an inversion, a momentum, right? So I want a liquidity sweep. I want to tap into a higher time frame fair value gap. And then I want an inversion back in my direction with momentum, right? So right here was an NQ long that I took based off of the 5-minute chart. Now, I use this as one of two examples about the point I made as to price is fractal, right? So you can see that this appears on the 5-minute time frame. It's a perfect trade, and this is the type of trade I would take a futures trade on, okay? The reason being it's happening on the 5-minute chart intraday, so you can expect whatever move is brewing here to at least work or not work by the end of the day, right? Because this was like a lunchtime trade, so it's on the 5-minute chart, it's intraday, you're basing it off lower time frame. Therefore, there should be no need to swing trade this, right? You don't enter swing trades off a 5-minute time frame. So in this example of my stim model working out for longs, you would enter this on the 5-minute and you would play it with futures. Now here we have a 1-hour example, right? We got the liquidity sweep. We were delivering off a fair value gap to the left. And we have this inversion right here with momentum. Now notice this is on the 1-hour chart. And our targets at this time were about 2% downside. Now, why would you want to play options and not futures with this trade? Well, I'm speaking from the perspective of someone who uses prop firms. I think prop firms are one of the most advantageous way to trade. They give you great leverage without having to put almost any of your own capital down. And with prop firms, as we know, you are not allowed to swing trade or hold overnight, okay? Now, why is that important? Because if you're entering on a prop firm, which I think most of you guys trade, right? Most people don't have tens of thousands in their live futures accounts to swing futures overnight. If you enter on this 1 hour based on this inversion, you're going to want to trade options because say you enter on the 1 hour chart. Well, do you really expect the entire rest of the move to play out very quickly? No, oftentimes if you're entering on the 1 hour, 4 hour daily, the move can take several days to complete, in which case here it did. It took over a day to complete. So why would you enter a futures trade on a prop firm to try to take this short? Because look, we chopped for 3 hours after we actually inverted this. So if you were trading on a prop firm, you wouldn't have gotten anywhere. You probably would have gotten stopped out or something. It just would have been a weird type of trade to take on a prop firm. But if you're trading options and you buy puts here to swing and you know that, okay, I'll wait for a little while for these so that we can hit my targets, you're going to be in a better spot, right? Now, obviously, it depends what contract you buy. You need to know the importance of buying time, all these type of factors that really are going to make or break your option success. But just know that you shouldn't be taking a prop firm futures trade on a move like this when it's likely going to take a while to actually fully play out down to your target, which it did in this case. Okay, so if you see my model, or really any model, but specifically mine, I'm just giving my experience here, the stim model, if you see it on the 1 hour or above, you probably want to be swing trading, however that looks like for you. And some people like to do shares, right? Like SPXS or SPXL, the leverage ES, right? Those are just shares. Some people don't love options, but make sure you're not trading prop firms on the 1 hour, 4 hour, or 1 day futures setups or index setups, okay? That's something that you want to save for like 15, 5, 3, 2, 1 minute chart entries, right? The futures are best for that. Now, with options, like I said, they're better for swing trades that you will suspect will take multiple days to play out. So you really want to be buying time with these because otherwise theta decay can kill you. Now, this is not an options lesson, okay? I'm expecting people who are watching this video to have a base understanding of what options are and what they do. But for the sake of simplicity, if you don't, just understand that with options, they basically lose value because they have priced in extrinsic value, especially if they're at or out of the money. They'll slowly lose value over time, and that loss of value exponentially increases towards their expiration date if the trade is not going your way, or if the trade is just flat and it's not really moving. Okay. So if you're buying options that are out of the money, like I said, you're paying for extrinsic value. You're paying for the possibility of that stock or equity to hit your targets or to start moving in your direction by the expiration date. Now, what that means is that the closer it gets to expiration date, if you're buying at or out of the money, you're going to start losing this extrinsic value quicker and quicker. It's like an exponential loss, right, of the extrinsic value. So what you want to do, if you expect a trade to take, I want to say, a few days to play out, maybe buy options that are a few months out. Yes, it's more costly, but buying time is going to save you because it allows you to basically sit through while the trade may just be stagnating, and you're not going to lose everything, which you would maybe if you had bought options that expire in a few days. And say I buy, puts for QQQ on a Monday and they expire this Friday, and I'm looking for a 2% move down to whatever great target I have, right? Kind of like what we had up here. Say we had chopped all week. Okay. Well, if I had bought options expiring that same week on Monday, if I had bought the Friday expiration options, I would have lost everything, right? If they're out of the money, I'm not getting a move down to my target. But say we chopped for a week and I had options that were 2 months out, and then the next week we got the move, then I'm actually going to be up on those options quite a bit, most likely, right? So obviously there's nuances. Options are complicated, but that's just a general thing. You want to buy time. Now, there is an exception where they can be better than futures for day trades, but ideally and in most situations, futures are better for lower time frame trades, right? 1, 2, 3, 5, and 15-minute entries, because they can capture intraday moves without getting devalued by chop. Okay, because like I just said, longer time frame options can not get devalued much by chop, but for smaller scalp type of targets, they're also not going to go up much if they hit your target most of the time, right? So with options, it's usually best to save them for swings, because you're either going to buy, contracts that are really close to expiring to capture the volatility, but then if it chops or goes against you, you're going to get cooked. So with futures, it's just safer, right? You get the best of both worlds, except in this one situation that I'm about to go over, okay? So SPX, SPY, QQQ, 0 DTEs after 3:30 p.m. and ideally with a lower VIX can actually be very beneficial. Now, I will scream this. Do not just get on at 3:30 and look for setups and force it just because you want to take 0 DTE options, okay? That's stupid. But what I am saying is that there will be rare scenarios where there's just an A+ setup in the late afternoon session before market close. A lot of times this will happen after like a Fed meeting once Jerome Powell's done talking. And what's going to happen is you're going to find 0 DTEs for index options either at or just out of the money for dirt cheap. Now, why is this? It's because they've lost all of their extrinsic or almost all of their extrinsic time-based value because that theta has almost all decayed, right? Because there's almost no time left until these options expire. So they're not being priced to work out very well or to move very much in your direction because there's so little time left, right? These options have been up on the board for years, months, and you're getting to the 30 minutes before they expire, so they're very cheap. Now, why can this be an improved risk reward or an ability to capture outsized moves? Well, it's very risky. And what's going to happen if the trades don't go your way, and once again, it's rare to find great setups, at 3:30 p.m. Eastern or after, but if you do, it's rare. It's not a bad idea to take it with SPX or SPY or QQQ 0 DTE options because, like I said, what's going to happen is you're going to get them for dirt cheap. And what you can do is play around with the futures. So say you want to put a bracket up and just see, like, if you were to take this trade on futures, what would my profit target be and what would my max loss be? And what you're going to see oftentimes is that if you take your max loss limit, so say I had my brackets set up and my max loss on a trade with futures, I'm willing to lose 300. If you put that 300 then into 0 DTEs, if the move actually goes your way and you hit your target, you're probably going to make a ton more money than you would have made if your futures trade had hit the target, especially if, it's like a decent amount of points to your target, right? The reason for that is because these contracts are so sensitive that if they start going in your way and in the money, you can capture, 500, 1000% returns in the last half hour. Sometimes it's even more. So once again, options between, 9:30 and 11, which is when I mostly trade, like zero DTE is not worth it because you're still paying a little bit too much time premium because they still have the whole rest of the day left. And like I said, if you just end up chopping and consolidating, you can sit in your futures trade for however long you want. Just set your limit, stop, walk away from the computer. But with the options, you're going to get fried. So that's why you want to wait till the end of day, if at all. And that's when you can actually get a leg up on some of these options plays. If you have an A plus setup with a very clear draw on liquidity, and it's enough points away to where the option can actually get comfortably in the money if you bought it out of the money. And in that case, and in those cases, like I said, with QQQ, SPY, and SPX, you might get, 500, 1,000, 2,000% return in the last half hour. So the risk reward is advantage options in these scenarios. They're very rare though, but I wanted to bring it up because it can like make your week, right? If you hit a good trade like this, don't go, trying to hit it or trying to force it. Obviously the risk reward improves, but the better thing, and I guess the good thing about this system is that if you're just sizing for your max futures loss with these zero DTEs, it's like basically you can't lose more than you put in with options. So you're either hitting your stop loss, right? If the trade doesn't go your way at all, or you are hitting your target and making outsized gains. Now, the one obvious caveat here is that if you just chop for the last, 20, 30 minutes of the day, your options are probably going to go worthless, whereas your futures would have broken even. So yes, that's something to consider. But if you're very confident in the draw and liquidity, especially on a volatile afternoon, after news has passed, right? Like Fed meetings, it can be a very big advantage and a net positive to try for zero DTE calls or puts on SPY, QQQ, or SPX. So once again, none of this was financial advice. I'm just giving my perspective on options and futures. And I will say, full transparency, I much prefer futures for almost every situation. But like I said, there is a time and place for options, and they can allow you to capture great moves using your system on higher time frames, or maybe using your system towards the very end of the day when the risk reward for SPX options or SPY or QQQ 0 DTEs just becomes very, very favorable. Okay, so if you're still watching, you're probably serious about trading. If that's the case, make sure to like the video and sub, and also join my free trading Discord. It is completely free. Just click the link in my YouTube bio and you are in. No credit card, no email needed, nothing. Literally just join and you're in. And I interact with all of you. I get back to all of you and I enjoy doing so. So appreciate you all for watching. I'll catch you in the next one. Peace.